Allied lines might sound like a military term, but in insurance, they refer to a category of property coverages that are closely related to fire insurance. Think of them as complementary policies that are usually bundled with basic property coverage to provide a more complete shield against specific risks. So what falls under allied lines? The most common include windstorm and hail coverage, vandalism and malicious mischief, riot and civil commotion, sprinkler leakage, water damage, explosion, non-boiler, volcanic activity, and sometimes earthquake or flood coverage, though these are often separate endorsements or policies. Essentially, allied lines fill in the gaps that fire insurance doesn't cover on its own. They're especially important in high-risk geographies like coastal states vulnerable to hurricanes or regions prone to civil unrest. Now let's talk underwriting. When insurers underwrite allied lines, they evaluate several key factors. Geographic exposure. Is the property in a hurricane, flood, or wildfire zone? Building materials and construction. Are sprinkler systems installed? Is the roof impact resistant? Use of the property, residential, commercial, or industrial, all carry different risks. Loss history. Previous claims related to storm or water damage will impact pricing and eligibility. Underwriters may also consider the total insured value and how much risk the insurer wants to take on in a given area, especially after large catastrophes. What kind of claims show up under allied lines? Let's say there's a violent thunderstorm that damages a warehouse's roof and floods the inside. The water damage claim would likely fall under an allied lines provision. Or imagine a protest escalates and results in broken windows and vandalized storefronts. Those would also trigger allied lines coverage. Now, how big is the market? As of recent industry estimates, allied lines make up roughly $15 to $20 billion in direct written premium annually in the United States, depending on how you slice the category. That number has been rising with inflation, growing insured property values, and increasing weather-related claims. It's also important to note that allied lines are usually bundled with property insurance. So, their exact market size often overlaps with broader commercial and personal property lines. Still, they represent a significant and growing segment of the property and casualty market. So, what does the future hold for allied lines? Two big trends are driving change. Climate change. More frequent and severe storms, wildfires, and floods mean insurers must continually reassess their exposure and pricing for allied perils. Reinsurance costs. Since many of these risks are shared with reinsurers, rising reinsurance rates could lead to more expensive premiums or tighter underwriting on allied coverages. Additionally, technology is improving risk modeling, which could allow for more accurate pricing and tailored coverage. Think AI-driven risk scoring and remote inspections to better evaluate properties. On the flip side, growing risk in catastrophe-prone areas may lead to coverage exclusions or limits, pushing some risks into the excess and surplus market or forcing policyholders to seek coverage through state-backed insurers of last resort. In short, allied lines may not be the flashiest corner of insurance, but they're critical, especially as extreme weather and civil disturbances become more common. If you're diving deeper into P&C insurance or exploring a career in the field, make sure to like, subscribe, and follow Insur Knowledge for more industry insights and breakdowns that help you stay informed and ahead of the curve.